Can something become less risky the longer it exists? When it comes to Bitcoin, the answer might surprise you. Larry Lepard, a veteran investor and fund manager, brings decades of traditional finance experience to help us understand Bitcoin's evolving risk profile. In today's discussion, we'll examine 3 central points: Bitcoin's impressive 16-year operational track record, the significant reduction in regulatory risk through institutional adoption, and the transformation from an experimental technology to an established financial movement. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. The final segment reveals a fascinating perspective on Bitcoin's journey, from a fringe experiment to a global phenomenon. But first, let's explore why Bitcoin's lengthy track record matters more than you might think.
I mean, when people say this is going to blow up or it's a Ponzi, I say, why? Show me the case and explain to me why. I mean, the only ways it fails, in my view, are massive technical failure. I think we're beyond that statistically in terms of the number of blocks and time it's run. The other is if everybody loses interest. If suddenly, I've often said, money really is a collective illusion. Money is just what we all agree to be money. And that was Menger's great point. Carl Menger, the founder of Austrian School of Economics. And so, if suddenly we all decide, this stuff's just not so great, I don't care about it anymore, let's, something else is better, let's go somewhere. Well, that would be an issue. But that's not really what we've seen happen. The adoption, wallets, hash, whatever metric you want to use, they're all growing solidly, continually. Use cases, etc. So
Larry's analysis provides compelling evidence for Bitcoin's remarkable security and operational resilience. When evaluating any financial technology, especially one handling trillions in value, the track record is crucial. Bitcoin has been running continuously for 16 years, longer than many major tech companies have existed. During this time, it has processed millions of transactions worth trillions of dollars without a single successful attack on its core network. This operational history directly addresses the first pillar of our decreasing risk thesis. Larry identifies only 2 potential failure modes for Bitcoin: either a catastrophic technical failure, which becomes increasingly unlikely with each passing year of successful operation, or a complete loss of social consensus, meaning everyone simultaneously decides to abandon it. The latter scenario helps us understand what gives any form of money its value. Whether we're talking about gold, dollars, or Bitcoin, money only works because we collectively agree it has value. This concept of collective agreement that Larry references from Menger isn't just theoretical. It's been practically demonstrated through Bitcoin's growing adoption and usage over 16 years. Each year of successful operation strengthens this social consensus and makes a mass abandonment increasingly improbable. We've now established Bitcoin's technical resilience, but the story of decreasing risk goes far beyond just operational success. As we'll see in our next segment, the traditional financial world's growing acceptance of Bitcoin marks another crucial milestone in reducing risk, but make sure to stick around for our final segment where we'll discover how Bitcoin transformed from an experimental technology into a global movement.
Well, that's exactly right. The risk is significantly lower. I remember talking to people about it, and frankly I was concerned about it, that the government was going to outlaw it, ban it, tax it, attack it, etc. And then the ETF got approved, and suddenly that was no longer such a big issue. So, it's clearly starting to go mainstream, as we all can see. And, Saylor talks about, we're in the, really in the 10-year kind of gold rush period where it's going to, I think, just explode into everybody's consciousness. When it gets to 200 and 300 and 400, people are going to be wondering, hang on a second, what is going on here?
Yeah.
This isn't a bubble. This is a movement.
The institutional adoption of Bitcoin represents a seismic shift in how the traditional financial world views this technology, directly addressing the second element of our decreasing risk thesis. Through my work on the TFTC podcast, I've witnessed firsthand the remarkable evolution in institutional attitudes since 2013. Larry highlights a pivotal point about risk perception. The approval of Bitcoin ETFs marks a watershed moment in Bitcoin's journey toward mainstream acceptance. This development is particularly significant because it addresses one of the biggest historical concerns about Bitcoin: regulatory risk. For years, many investors remained on the sidelines due to fears of government crackdown or outright bans. The ETF approval signals that Bitcoin has crossed a threshold where such dramatic regulatory action becomes increasingly unlikely.
Everyone knows about Fold. It's the app where you can earn the most Bitcoin rewards for everyday purchases. Fold now lets you double stack rewards with gift cards. Use your credit or debit card to buy gift cards and earn both credit card rewards and sats. Fold gift cards help you grow your stack with every purchase. If you're not shopping with Fold gift cards, you're leaving sats on the table. Get a 20,000 sat welcome bonus. Go sign up now at foldapp.com/Marty.
Consider the implications. Once major financial institutions have integrated Bitcoin into their offerings and millions of Americans have exposure through their retirement accounts, the political cost of hostile action against Bitcoin becomes prohibitively high. Larry's reference to a 10-year gold rush suggests we're entering a new phase where institutional involvement could accelerate adoption. This creates a powerful feedback loop. Better institutional infrastructure makes Bitcoin more accessible and secure, which attracts more institutions, which further improves the infrastructure. This process is transforming Bitcoin from what many viewed as a risky, speculative asset into an increasingly mainstream financial tool. We've now seen how both Bitcoin's technical track record and institutional adoption have significantly reduced its risk profile. But don't leave yet. Our final segment reveals the fascinating transformation from experimental technology to established movement, completing our understanding of Bitcoin's decreasing risk profile.
I mean, I bought some at 300 or 400. God, I wish I'd bought 10 times as much. But I didn't have the vision to do it. And, I thought it was going to fail. I wasn't sure. To me, it was an experiment in 2013 or 14, Now it's no longer an experiment. It's a movement, So.
And that's the point I was just going to make. Like, you can easily make the argument, yes, the price tag that you see on a per Bitcoin basis is obviously right below all-time highs. So it seems like the most expensive ever. But to your point there, many people thought it was, and many people, I think, it would accurately describe it as an experiment back then. And so from a risk-adjusted perspective today,
the evolution of Bitcoin from an experimental technology to a global movement, which I've witnessed firsthand through my work at 1031 and the TFTC podcast, completes our analysis of Bitcoin's decreasing risk profile. Larry's reflection on his early skepticism is particularly revealing because it perfectly illustrates the final component of our thesis: the transition from experiment to established movement. In 2013 to 2014, when Larry first encountered Bitcoin, approaching it with skepticism was entirely rational. We had no guarantee the network would survive, no proof it could scale, and no evidence it could maintain its security over time. The price levels he mentions, $300 to $400, seem remarkably low now, but at the time, investing even at those prices required tremendous conviction in an unproven technology. What's fascinating about Larry's perspective is how clearly he articulates this fundamental shift in Bitcoin's status. We've moved beyond questioning whether Bitcoin will work to exploring how deeply it will integrate into the global financial system. This evolution from experiment to movement isn't just about price appreciation. It's about the development of an entire ecosystem of technology, services, and infrastructure built around Bitcoin. The network has demonstrated its resilience through multiple market cycles, survived countless predicted death events, and continued to operate exactly as designed. When Larry acknowledges that many people accurately describe Bitcoin as an experiment in its early days, he's highlighting a crucial point about risk assessment. The risks associated with Bitcoin today are fundamentally different from those in its early years. This perfectly completes our decreasing risk thesis. We've seen how Bitcoin's technical track record proved its reliability, how institutional adoption reduced regulatory risks, and now how the transition from experiment to movement has fundamentally altered the nature of Bitcoin's risk profile. We're no longer wondering if the basic concept works. Instead, we're focused on how the technology will be integrated into the global financial system. This maturation process demonstrates how Bitcoin's risk profile has fundamentally changed. The experimental phase, with all its associated uncertainties, has been successfully navigated, and we've entered a new era where the primary considerations are about adoption and integration rather than fundamental viability. Will Bitcoin's evolution from experiment to Wall Street favorite continue? Let me know in the comments. I read every single one. And if you found this risk analysis interesting, you'll want to watch our breakdown of Bitcoin's path through monetary collapse. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.